This question tests the understanding of variable costing and the identification of costs that change directly with each flight operated. In a contribution margin income statement, costs are classified as variable or fixed, rather than by function. Variable costs increase or decrease according to the number of flights, while fixed costs remain unchanged within the relevant range. The key phrase is variable cost per flight. Students should identify costs that are incurred only when a flight operates, and that vary with the number of flights. Costs such as fuel consumption, passenger meals, and airport landing charges are typically flight-specific. In contrast, depreciation, advertising, communication infrastructure, and many employee salaries are generally fixed or semi-fixed and do not vary directly with each individual flight. Therefore, the correct answer must consist entirely of costs that are avoidable if the flight is not operated. A. Flight crew salary, fuel, and engine maintenance. Incorrect. Fuel is variable, but flight crew salaries are often fixed contractual costs, and engine maintenance is frequently scheduled rather than varying directly with each flight. B. Fuel, food service, and airport landing fees. Correct. Fuel depends on each flight, food service varies with passengers served, and landing fees are incurred whenever a flight lands. All are variable operating costs per flight. C. Airplane depreciation, baggage handling, and airline marketing. Incorrect. Depreciation and marketing are fixed costs, although baggage handling may vary. D. Communication system operation, food service, and ramp personnel. Incorrect. Food service is variable, but communication system operation and ramp personnel costs are generally fixed or semi-fixed. Correct answer: B. Fuel, food service, and airport landing fees. These costs best represent the variable cost per flight used in contribution margin analysis. This question examines the distinction between manufacturing costs, product costs, and non-manufacturing costs, period costs, a fundamental concept in management accounting and cost accounting. Manufacturing costs are all costs incurred to produce a product and are included in inventory until the goods are sold. They consist of direct materials, raw materials physically incorporated into the product, direct labor, labor directly involved in production, and manufacturing overhead, indirect production costs such as factory utilities, factory insurance, depreciation, and plant property taxes. Non-manufacturing costs are associated with selling, marketing, distribution, and administration rather than production. These costs are expensed in the period incurred and are not included in inventory valuation. The key to answering this question is identifying which cost is unrelated to the manufacturing process. A. Cream for an ice cream maker. Incorrect. Cream is a direct material that becomes part of the finished ice cream, making it a manufacturing cost. B. Sales commissions for a car manufacturer. Correct. Sales commissions are selling expenses, incurred to market and sell products rather than manufacture them. They are classified as non-manufacturing, period, costs. C. Plant property taxes for an ice cream maker. Incorrect. Property taxes on a manufacturing plant are manufacturing overhead, an indirect production cost. D. Tires for an automobile manufacturer. Incorrect. Tires are a direct material used in assembling automobiles and therefore represent a manufacturing cost. Correct answer: B. Sales commissions for a car manufacturer. Sales commissions are selling costs rather than production costs, and therefore are not considered manufacturing costs. This question tests the concept of cost behavior, specifically how different types of costs respond to changes in the volume of activity within the relevant range. Understanding cost behavior is essential for budgeting, cost volume profit, CVP, analysis, pricing decisions, and managerial planning. The key phrase is remains the same as the volume of activity decreases within the relevant range. Students should recall the fundamental rules. Variable cost per unit remains constant, regardless of changes in production or sales volume within the relevant range. Total variable cost changes proportionately with activity. Total fixed cost remains constant within the relevant range, but fixed cost per unit changes inversely with activity because the same fixed cost is spread over different numbers of units. Average cost per unit generally changes when output changes because it includes both fixed and variable components. Therefore, the question asks which cost measure does not change on a per unit basis when activity levels increase or decrease. A. Average cost per unit. Incorrect. Average cost per unit changes as production volume changes because fixed costs are allocated over different numbers of units. B. Variable cost per unit. Correct. Variable cost per unit, such as direct materials or direct labor per unit, remains constant within the relevant range, even if activity decreases or increases. C. Unit fixed cost. Incorrect. Fixed cost per unit increases when production decreases because the same total fixed cost is divided among fewer units. D. Total variable cost. Incorrect. Total variable cost changes directly with activity and decreases as production volume decreases. Correct answer. B. Variable cost per unit. Variable cost per unit remains constant within the relevant range, making it a key assumption in cost behavior and managerial accounting analysis.